rise of alternative finance in Europe has been the opportunity for a number of companies, especially small companies, to diversify the sources of capital and contribute to reduce the finance gap. It has been the opportunity also to gain competencies in finance and in the relationship with professional investors, competencies that are typically missing in small companies. Nevertheless, alternative finance is also an interesting asset class for investors, both retail savers and sophisticated professional investors. Let's start from small investors. Crowd investing is the main example. By grouping many small contributions from the crowd, it is possible to share the risk among several investors and to access types of investments which are normally difficult to be targeted by individuals. We can mention the case of real estate. Investing into a real estate property or project normally requires a significant amount of money, and risk diversification is even more complex because we should invest into several projects. With crowdfunding, it is possible to finance projects collecting small amounts from different pledgers. Of course, in the case of donation-based crowdfunding, there is no tangible return for the pledgers, while in reward-based crowdfunding, the return is a gift or a product, but it's not an investment. In equity crowdfunding, investors will earn a profit as soon as the investee company will be bought by another company or will go public on the stock exchange. This event is called exit. Recent academic research carried out on a sample of exits from European small companies that raised money through equity crowdfunding found an average annual return equal to 8.8%. But the research also shows that 10% of the investee companies failed and closed. This highlighting that the risk is also significant. In fact, many of the companies that run an equity crowdfunding campaign in Europe are startup companies. In lending-based crowdfunding, we may rely on the statistics released by the single platforms. The gross annual return for investors is typically comprised between 5% and 6%. If you want to consider crowd investing, our suggestion is to learn about the regulation in your own country and review the characteristics of the crowdfunding platforms, considering the track record and the past performance. Be careful when reviewing the risk of the investment, which should be clearly highlighted. In some European countries, small savers can also subscribe debt securities and bonds issued by small companies. The interest rate offered to lenders will depend on the rating of the issuer and on the loan maturity, as well as on the existence of guarantees and credit enhancement mechanisms. In the case of unsecured loans, the interest rate is usually between 5% and 7%. Also in this case, we have to warn savers, because we are talking about small issuers, and the risk of default can be relevant. Therefore, have a close look at the materials and memorandum released by the issuer. When it comes to professional institutional investors, we have a number of specialized players. Private equity and venture capital investors are typically closed-end funds, since they provide finance for the long run. Statistics from Prekin highlight that the median net internal rate of return for private equity investors around Europe in the last 10 years has been around 13%. This asset class is usually accessible for banks, insurance companies, foundations, pension funds, but also wealthy individuals. They are the lead investors behind the closed-end fund. In the case of venture capital, returns can be larger, but the risk is also larger because we deal with startup companies. Alongside venture capital funds, wealthy individuals like business angels are used to invest directly in venture capital. Credit funds invest into the debt of small companies. They can subscribe bonds or lend directly to companies. As we said before, their return is linked to the rating of the issuer, to the maturity, to the availability of any collateral or pledge on the loan. Credit funds also invest in peer-to-peer lending alongside the crowd and into invoice trading platforms. In this latter case, the annual return is typically comprised between 6% and 8% because investors buy commercial invoices and take the risk of any missing payment. The peculiarity for invoice trading is that the duration of the investment is very short. Invoices are typically paid after 2-3 months, and money is reinvested more times during a year. Moreover, credits from commercial invoices or generally from any loan can be securitized to create asset-backed securities. The European Union is spending many efforts to push alternative finance for SMEs, and the new instrument that has been created is the European Long-Term Investment Fund, LTIF, to create a barrier-free market for collective investment funds and democratize finance. LTIFs must invest at least 70% in eligible long-term investments, non-listed companies, direct holdings of real assets with a value of over 10 million euro, units of other LTIFs, venture capital, private equity, or credit funds. They are the opportunity for small, unsophisticated savers to join the alternative finance arena. The largest banks and asset management companies around Europe are now creating a number of LTIFs. You can look for the official prospectuses. Concluding, we can say that investments into alternative finance are able to provide interesting returns to investors. To a larger extent, if we consider that low-risk assets like European government bonds and securities issued by large, mature companies are delivering poor returns, even negative, due to the quantitative easing monetary policies. Yet, we must carefully consider the risk when the investee company is a small enterprise. Therefore, the main recommendation is to consider an investment into alternative finance assets as the opportunity to diversify a limited part of the portfolio wealth. Otherwise, it is better to leave the scene to professional investors.